Before we begin, a brief word. If you're seeking thoughtful, disciplined perspectives on markets and asset allocation, perspectives grounded in history, data, and emotional clarity, consider subscribing to this channel. We don't chase hype, we don't promise riches. We study cycles, human behavior, and what actually moves wealth over time. You'll find the subscribe button below this video highlighted in red. A single click helps you stay informed without the noise. Now, let's begin. Gold has been moving. Not erratically, not violently, but steadily, persistently upward, breaking through psychological barriers, reclaiming all-time highs, and holding ground with remarkable resilience. This is not a speculative frenzy. This is something different. Gold's behavior in recent months carries a message. It's a signal from the deeper currents of global finance, a warning that the monetary environment has shifted, that confidence in traditional systems is being quietly tested, that investors worldwide are repositioning for what comes next. And when gold moves this way, history tells us to watch silver, because silver doesn't just follow gold. When conditions align, silver amplifies gold's moves with extraordinary force, sometimes by multiples, sometimes with shocking speed. Today, we're going to examine why gold's current surge matters, what it reveals about the state of global markets, and why silver could be positioned for a parabolic move in 2026. This isn't speculation, it's pattern recognition. We'll explore the mechanics, the psychology, the historical parallels, and most importantly, what you should actually do with this information, whether you already hold these assets or you're considering your first position. Let's proceed with clarity and discipline. Before we discuss what might happen, we need to understand what these metals actually are in the context of modern finance. Gold is monetary insurance. It's the asset that holds value when paper currencies falter, when central banks expand balance sheets beyond historical norms, when government debt reaches levels that make repayment mathematically questionable. Gold doesn't pay dividends. It doesn't generate cash flow. It simply exists as a store of value that has been recognized for thousands of years across every civilization. Silver occupies a different position. Silver is both a monetary metal and an industrial commodity. It's used in solar panels, electronics, medical equipment, and countless manufacturing processes. This dual nature makes silver more volatile, more responsive to both monetary forces and economic growth. But here's what matters most, the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Throughout history, this ratio has fluctuated dramatically, and these fluctuations create some of the most powerful wealth transfer opportunities in commodity markets. When the ratio is high, meaning silver is cheap relative to gold, it signals that silver has been overlooked, undervalued, compressed by market forces. When conditions shift and silver begins to catch up, the moves can be breathtaking. In 2011, silver moved from roughly $17 per ounce to nearly $50 in a matter of months. In 1980, it went from single digits to $50. These weren't gradual appreciations. They were parabolic explosions. The question before us now, are we entering similar conditions? To understand where silver might go, we must first understand why gold is moving now. Gold responds to specific conditions. The first is monetary expansion. When central banks create currency at rates that exceed real economic growth, the purchasing power of that currency inevitably declines. Gold maintains its value by rising in nominal terms. Look at the past 4 years. Central bank balance sheets expanded to unprecedented levels. Government spending reached peacetime records. Debt to GDP ratios climbed into territory previously seen only during major wars. This isn't sustainable indefinitely. Markets know this. The second force is geopolitical fragmentation. And we're watching the slow unwinding of the post-1971 dollar-centric monetary system. Nations are diversifying reserves. Central banks are buying physical gold at rates not seen in decades. Trade settlements are increasingly occurring outside traditional dollar channels. This doesn't mean the dollar collapses tomorrow. It means confidence is being recalibrated across a multi-year horizon. The third force is real interest rates. When interest rates, adjusted for inflation, remain low or negative, holding gold becomes rational. There's no opportunity cost. Cash loses value. Bonds provide insufficient real returns. Gold preserves wealth without requiring faith in policy decisions. These three forces, monetary expansion, geopolitical shift, and real rate compression, are converging simultaneously. That's why gold is moving. Not because of speculation, because of structural conditions that favor hard assets over paper promises. Let's be specific about where we stand. Global debt has reached levels that would have been considered catastrophic just 2 decades ago. In many developed nations, debt to GDP ratios exceed 100%, or 120%, even 150%. How does this debt get resolved? Historically, there are only a few paths: dramatic economic growth, explicit default, or inflation that erodes the real burden. Dramatic growth seems unlikely given demographic headwinds, productivity challenges, and existing debt service requirements. Explicit default would trigger financial chaos that governments will avoid at almost any cost. That leaves inflation, not necessarily hyperinflation, but persistent above-target inflation that slowly reduces the real value of obligations. Gold understands this arithmetic. Central banks face an impossible dilemma. Raise rates too high and debt service becomes unsustainable. Keep rates too low and inflation remains embedded in the system. Neither path is bullish for paper currencies. Both paths favor hard assets. This is the environment we're operating in. This is why institutional investors, sovereign wealth funds, and family offices are increasing their gold allocations. They're not betting on apocalypse. They're hedging against mathematical certainties. Now we turn to silver. If gold is moving because of monetary conditions, why hasn't silver kept pace? This lag is precisely what creates the opportunity and the risk. Silver has been suppressed by several factors. Industrial demand concerns during economic uncertainty, large concentrated short positions in futures markets, general investor disinterest in physical commodities during the tech and growth stock era. But these conditions are shifting. First, industrial demand for silver is accelerating. The green energy transition requires massive amounts of silver for solar panel production. Electric vehicles use more silver than traditional cars. 5G infrastructure, artificial intelligence data centers, all of these require silver. Unlike gold, where annual production roughly matches annual demand, silver faces structural supply challenges. Many silver mines are aging, grade quality is declining, and silver is often a byproduct of other mining operations, making supply less responsive to price. Second, investor positioning remains historically light. During previous silver runs, retail and institutional investors held significant physical positions. Today, most portfolios have zero silver exposure. Exchange-traded products hold a fraction of what they held in 2011. This means there's massive dry powder, capital that could flow into silver if the narrative shifts. Third, the gold-silver ratio remains elevated. While the historical average sits around 60 to 70, the ratio has been trading in the 80 to 90 range for extended periods. This compression of silver relative to gold represents potential energy. When this ratio begins to contract, when silver starts outperforming gold, the move typically accelerates as momentum traders, algorithmic systems, and momentum-following investors pile in. Let's examine the historical record without romanticizing it.
In 1979-1980, silver experienced its most famous parabolic move. The Hunt brothers attempted to corner the market, but the underlying conditions also included high inflation, Soviet tensions, and monetary instability. Silver went from below $10 to $50 in roughly 18 months. Then it crashed just as violently. In 2010-2011, following the global financial crisis and massive quantitative easing, silver rose from $17 to $48 in approximately 6 months. Again, the move was parabolic. Again, the subsequent correction was severe. What do these episodes teach us? First, silver can move with extraordinary speed when monetary conditions, supply constraints, and investor psychology align. Second, these moves attract speculative excess. Retail investors buy at tops. Leverage amplifies both gains and losses. Emotional decision-making destroys capital. Third, the moves are not permanent. Silver's volatility means that timing and risk management matter enormously. We're not studying history to predict exact replays. We're studying it to understand what's possible, what triggers these moves, and how to position accordingly. Why might 2026 represent a critical inflection point for silver? Several threads are converging. First, the lag effect of monetary policy. Decisions made in 2021 and 2022 regarding money supply expansion, fiscal stimulus, and debt monetization take years to fully manifest in real prices and asset markets. The inflation we've experienced may not be a temporary episode, but the beginning of a regime change, a return to a world where currency debasement becomes the primary tool of debt management. Second, the industrial demand trajectory is accelerating beyond previous cycles. The green energy transition isn't slowing, it's expanding. China, Europe, and the United States are all committed to massive infrastructure spending that will consume increasing quantities of silver for decades. This creates a floor under prices that didn't exist in previous cycles. Third, the generational wealth transfer is underway. Younger investors, having experienced multiple financial crises, cryptocurrency volatility, and persistent inflation, are increasingly skeptical of traditional paper assets. Physical metals, once seen as old-fashioned, are being reconsidered. This demographic shift could bring new capital into a relatively small market. Fourth, The geopolitical landscape is increasingly multipolar. De-dollarization efforts are gaining momentum. BRICS nations are exploring alternative settlement systems. Even friendly nations are diversifying reserves. This doesn't require belief in dollar collapse, just recognition that monetary hegemony is being gradually redistributed. In this environment, both gold and silver serve as neutral reserve assets. These factors don't guarantee parabolic moves, but they create conditions where parabolic moves become possible. Let's talk about what parabolic actually means in market terms. A parabolic move isn't just a price increase, it's a specific pattern where the rate of change itself accelerates, where each new high is reached faster than the previous one. This happens when multiple feedback loops activate simultaneously. First, fundamental buyers enter, those who want physical exposure for portfolio diversification or industrial need. Then momentum traders notice the trend and add positions. Then retail investors, seeing consistent gains, overcome their hesitation and buy. Then algorithmic systems designed to follow trends add programmatic buying. Then media coverage intensifies, bringing in the final wave of late entrants. Each wave provides liquidity and momentum for the next. The move becomes self-reinforcing until it exhausts either available capital or the supply of willing buyers at elevated prices. In silver's case, the relatively small market size means these moves can be more dramatic than in larger asset classes. The entire silver market is smaller than many individual tech companies. When significant capital flows in, prices can move dramatically. But understand this clearly. Parabolic moves are extremely dangerous for undisciplined investors. The majority of people who participate in parabolic moves lose money because they enter late, use excessive leverage, and fail to take profits before the inevitable correction. Recognition of potential is not the same as guaranteed profit. If you already hold gold or silver, your approach should reflect patience and discipline. First, recognize what you own and why you own it. If you hold these metals as monetary insurance, as protection against currency debasement and financial system stress, then short-term price movements are largely irrelevant. Your position serves a specific purpose in your portfolio. It's not a trading vehicle. It's wealth preservation. If prices rise dramatically, you might rebalance, but you don't abandon the position entirely because the fundamental risks you're hedging against haven't disappeared. Second, resist the urge to over-concentrate as prices rise. When assets perform well, there's a natural psychological tendency to increase exposure. This often happens at exactly the wrong time, after significant appreciation when downside risk has increased. Disciplined investors maintain target allocations regardless of recent performance. Third, consider your exit strategy for speculative portions of holdings. If part of your silver position is speculative, held for potential appreciation rather than insurance, define your parameters now, before emotion becomes involved. At what price point would you take partial profits? What percentage would you consider selling? What signals would indicate the move is exhausting? These decisions are impossible to make rationally in the middle of a parabolic move when greed and fear dominate thinking. Fourth, prepare for volatility. If silver does enter a parabolic phase, the daily price swings will be significant. Positions that felt comfortable at $25 per ounce might feel terrifying at $45 per ounce, even though your position hasn't changed. Mental preparation for this volatility is as important as financial positioning. Fifth, ignore the noise. During speculative moves, social media, forums, and financial media become echo chambers of confirmation bias and hype. Every anecdote becomes evidence. Every prediction becomes certain. Maintain emotional distance. Remember your original thesis. Execute your plan. If you don't currently hold silver and you're considering a position, approach this with extreme care. First, understand the difference between investment and speculation. Allocating 5 to 10% of a diversified portfolio to physical precious metals as insurance is investment. Putting 50% of your net worth into silver futures hoping for quick gains is speculation. Know what you're doing and be honest about the risks involved. Second, consider dollar cost averaging rather than lump sum entry. If you believe structural conditions favor silver over multiple years, there's no urgency to capture the entire position immediately. Spreading purchases across months reduces timing risk and emotional pressure. You might miss some gains, but you'll also avoid the pain of buying at a temporary peak. Third, prioritize physical holdings or fully backed ETFs over derivatives. Futures contracts, options, and leveraged instruments amplify risk dramatically. For most investors, physical coins or bars or shares in physically backed ETFs provide adequate exposure without the complexity and risk of derivatives. If you don't understand contango, backwardation, and rollover costs in futures markets, you shouldn't be trading silver futures. Fourth, size positions appropriately for your risk tolerance. A position that causes you to check prices multiple times per day, that disrupts your sleep, that makes you anxious. That position is too large regardless of its potential. The right position size allows you to maintain emotional equilibrium during both advances and declines. Fifth, establish clear criteria for what would invalidate your thesis. What evidence would suggest you're wrong about silver's potential? What market conditions would indicate the opportunity has passed?
Strong opinions, weakly held. This is the mindset of effective investors. Be willing to change your mind when conditions change, making buy or sell decisions based on fear, greed, or daily price movements rather than rational analysis and predetermined strategy. When silver moves sharply in either direction, your brain will urge you to act. Evolution wired humans to respond to immediate threats, not to think in decades. Resist this urge. Follow your plan. Using borrowed money or derivatives that amplify exposure beyond what you could afford to lose entirely. Silver's volatility makes leverage exceptionally dangerous. A 20% decline in silver could trigger a 100% loss in a 5x leverage position. Many traders have been completely wiped out in single-day moves during volatile silver markets. Buying after silver has already risen 30%, 40%, or 50% simply because you fear missing out. The most expensive words in investing. This time, I won't miss it. Late entry after major appreciation dramatically increases your risk of buying near a temporary peak, concentrating wealth into a single asset class, no matter how compelling the thesis. No investment is certain. No analysis is perfect. Diversification is the only free lunch in finance. Even if silver rises dramatically, putting all your capital in silver exposes you to catastrophic loss if you're wrong, following social media hype, conspiracy theories, or prediction that promise certain outcomes. Markets are complex systems influenced by millions of decisions. No one knows the future with certainty. Your decisions should be based on probabilities, risk management, and historical patterns, not on guru predictions or viral threads. Failing to consider capital gains taxes, collectibles treatment, and timing of sales. In many jurisdictions, physical precious metals are taxed differently than stocks. Short-term gains may be taxed at ordinary income rates. Understanding these implications before you trade saves money and prevents unpleasant surprises. Waiting for perfect entry points, perfect information, or complete certainty before taking any action. If your analysis suggests precious metals belong in your portfolio, establish a modest position and adjust over time. Waiting for perfect clarity means never acting. Balance preparation with execution. Silver doesn't move in isolation. Several indicators deserve your attention. Watch the difference between nominal interest rates and actual inflation. When real rates are negative or very low, precious metals become more attractive. If real rates rise significantly, if central banks successfully bring inflation down while maintaining elevated nominal rates, this would create headwinds for metals. Precious metals typically move inversely to dollar strength. A weakening dollar tends to support metal prices. A strengthening dollar creates pressure. Monitor the DXY dollar index and consider how monetary policy divergence between countries affects currency values. Track official sector purchases of gold. When central banks are aggressive buyers, it signals concerns about the existing monetary system. This buying provides a fundamental floor under gold prices and indirectly supports silver. Supply matters. Watch quarterly production reports from major silver producers. Declining output would support price appreciation. Increasing output would provide resistance. Monitor solar panel installations, electric vehicle production, and electronics manufacturing. Silver's industrial use means economic growth matters. A recession would create headwinds for industrial demand, even as monetary concerns support prices. Watch positioning in futures markets through COT, commitment of traders. Reports. Extreme positioning in either direction often precedes reversals. When commercial hedgers are heavily short and speculators are heavily long, corrections often follow. The inverse can signal buying opportunities. This remains the key metric. When the ratio begins to decline rapidly, when silver significantly outperforms gold, it often indicates the beginning of a silver move. A break below 70, then 60 would be significant technical and psychological levels. Understanding crowd psychology is essential during volatile markets. Markets move through predictable emotional phases. Early in a bull market, most investors remain skeptical. Previous losses create hesitation. The asset feels expensive even though fundamentals are improving. This is typically the best time to build positions. As prices rise consistently, media coverage increases. Early investors who were criticized are now seen as prescient. More participants begin researching the asset. This phase offers reasonable entry points with manageable risk. Momentum is established. Most indicators are positive. The narrative becomes mainstream. Dinner party conversations turn to the asset. Risk is elevated, but gains can still be captured with discipline. Everyone is buying. Price targets escalate. Critics are dismissed. Traditional valuation metrics are called obsolete. This is where most money is lost. Late entrants buy at peaks. Early investors fail to take profits. Smart money begins exiting. Volume remains high, but price progress stalls. Most participants remain bullish, unaware the character has changed. Recognition of this phase separates successful investors from the crowd. The decline accelerates, leverage unwinds, forced selling creates cascading drops. Everyone who bought in euphoria sells in panic. This phase sets up the next cycle. Where might silver be in this cycle today? Arguably between phases 1 and 2. Growing awareness, but not yet enthusiasm. This is important context for positioning. Intellectual honesty requires examining contrary views. What could prevent silver from having a parabolic move? If alternatives to silver in industrial applications are developed and scaled, demand could decline. Copper or graphene might replace silver in certain uses. This would undermine the supply-demand thesis. If central banks successfully contain inflation while maintaining economic growth, the famous soft landing, real interest rates might rise sustainably. This would make yield-bearing assets more attractive than metals. A severe economic downturn would reduce industrial demand for silver. While monetary concerns might support prices, the industrial component could weaken significantly. Government intervention in commodity markets, changes to derivative trading rules, or restrictions on physical ownership could disrupt price discovery. While unlikely in Western markets, it's not impossible. Perhaps current conditions simply continue. Moderate inflation, moderate growth, manageable debt levels. No crisis, no panic, no catalyst for metals. Silver remains range-bound for years. These scenarios deserve consideration. Your position sizing should account for the possibility that your thesis is incomplete or wrong. Begin with education. Read about precious metals, history, market structure, and portfolio theory. Don't take positions based on a single video or article. Consider allocating 5% of your investment portfolio to precious metals as a starting point. Split this between gold and silver based on your risk tolerance, perhaps 60% gold, 40% silver. Research. Whether physical holdings, ETFs, or mining stocks best suit your situation. Make your first purchase. Start small. Experience what it feels like to own these assets through volatility. Review quarterly. Don't obsess over daily prices. Rebalance to target allocations. If silver has appreciated significantly, you might be overweight. Consider taking partial profits to return to target. Review storage arrangements for physical holdings. Ensure security and insurance are adequate. Consider tax loss harvesting opportunities if you have positions underwater. Document your current thesis and exit criteria. Write them down. Review them before making any trades. Understand that active trading of volatile commodities is exceptionally difficult. Most traders underperform simple buy and hold strategies after transaction costs and taxes. If you trade, use stop losses rigorously. Never risk more than 1 to 2% of capital on a single trade. Keep detailed records. Analyze your win rate and average gain versus average loss. If you're not consistently profitable, stop trading and switch to longer-term holding. Some retirement accounts allow precious metals exposure through ETFs or specific approved coins. Understand your account's rules. Metals in retirement accounts can provide diversification and inflation protection with tax advantages. Ensure your allocation aligns with your overall retirement timeline and risk profile. Your greatest enemy during volatile markets is yourself. Specifically, the emotional patterns that evolution designed for immediate physical threats, but which destroy wealth in financial markets. Write down your investment philosophy, risk tolerance, target allocations, and rebalancing rules. When emotion grips you during market swings, refer to this document. Follow the rules your rational self established. Limit how often you check prices. Daily price movements are essentially random noise. Consider checking monthly rather than daily. You'll make better decisions with less stress. Imagine silver rising 100%. How would you feel? What would you do? Imagine silver falling 30%. How would you feel? What would you do? Mental rehearsal of both scenarios reduces emotional intensity when they actually occur. Discuss your investment strategy with someone rational, a friend, advisor, or colleague who can provide objective perspective. Sometimes articulating your thoughts to another person reveals flawed logic you couldn't see alone. You cannot know the future. No one can. Your analysis provides probabilistic guidance, not certainty. Peace comes from accepting this uncertainty, managing it with diversification and position sizing, and focusing on process rather than outcomes. Success isn't capturing every gain, it's following your strategy, managing risk effectively, and achieving your long-term financial goals. You can have a successful investment experience even if silver doesn't go parabolic, as long as you acted rationally and maintained discipline. Time horizon dramatically affects appropriate strategy. Precious metals are inappropriate for short-term money. Volatility could easily result in losses when you need to liquidate. Use stable assets for short-term needs. Money market funds, short-term bonds, or cash. A modest allocation to metals provides some diversification, but recognize that timing risk is significant. Markets don't move on your schedule. Silver could remain flat or decline for extended periods. Ensure you're not depending on appreciation to meet specific financial goals. This is where precious metals can play a more significant role. Short-term volatility becomes less relevant. You're positioning for longer-term monetary trends and can weather interim corrections. Long horizons allow for maximum flexibility. You can build positions gradually, rebalance through volatility, and benefit from the full cycle. Your focus should be on fundamental conditions rather than timing specific moves. We've examined gold's message, silver's potential, historical patterns, market mechanics, and psychological factors. Now, for the most important truth, you don't need to predict the future to prepare for it. Whether silver goes parabolic in 2026 or not, the analysis we've conducted serves a purpose. It forces clarity about your financial position. It highlights risks in the current monetary system. It prompts consideration of diversification. It builds discipline around emotional decision-making. These are valuable regardless of silver's specific price path. The goal isn't to capture every possible gain. The goal is to construct a portfolio that allows you to meet your financial objectives across multiple possible futures. In some futures, precious metals perform exceptionally. In others, they merely preserve wealth while other assets drive returns. In still others, they underperform but provide stability during turbulent periods. Your portfolio should acknowledge all these possibilities. Real wealth is not built by predicting parabolic moves. Real wealth is built through consistent saving, disciplined investing, emotional regulation, continuous learning, and patience measured in decades. If silver rises dramatically and you have a position, you'll benefit. If it doesn't, you'll benefit from the diversification and insurance that position provided. If you don't have a position and silver rises, you haven't missed out. You've simply experienced one outcome among many possible ones. There will always be another opportunity. Markets operate in cycles. The investors who compound wealth aren't those who capture every move. They're those who avoid catastrophic mistakes. Focus on process, proper analysis, appropriate position sizing, disciplined rebalancing, and emotional control. Focus on principles, diversification, risk management, long-term perspective, and continuous learning. Focus on personal financial goals, retirement security, family provision, independence, and freedom from financial stress. These matter more than whether silver reaches any particular price point. Gold's surge is indeed a warning that monetary conditions have shifted, that traditional anchors of financial stability are being tested, that intelligent investors are repositioning. Silver, with its unique properties and relatively small market, could amplify these forces dramatically if conditions continue to align. But whether that happens or not, your approach remains the same. Educate yourself thoroughly, understand what you own and why you own it, size positions appropriately, maintain diversification, control emotion, follow your strategy. And above all, remember that financial markets are tools for achieving life goals, not ends in themselves. Your success will be measured not by how accurately you predicted silver's path, but by whether you achieved financial security, maintained peace of mind, and created the life you sought. That requires discipline, not prescience. Preparation, not prediction. Thank you for your time and attention. If this analysis provided value, consider subscribing for continued thoughtful coverage of financial markets and investment strategy. The subscribe button is below, marked in red. Until next time, stay disciplined, stay informed, and stay focused on what actually matters.